Assalamualaikum listeners. Welcome back to the discussion of dividends, retained earnings, and income reporting in reference to the corporations. This is chapter number 14 of financial accounting. And in my previous recording regarding this chapter, we already covered learning objective number 1, which was about the basis for the dividends and cash dividend. Then in learning objective number 2, we have discussed up to stock dividend, that how do companies issue the stock dividend and what are the effects of stock dividend on companies' equity section. We are left with the stock split from learning objective number 2, and then after that we will move towards learning objective number 3, which is preparing and analyzing the comprehensive stockholders equity section, and learning objective number 4, in which we will see the classified balance sheets of the corporations. So let's start with the discussion of what is stock split. Split means break. So stock split means that you break your stock or share into parts. Let's suppose if company announced 2-for-1 stock split, then you are going to break one share into two parts. It will result in two things. Number one, the number of share will increase from 1 to 2 because now this is number 1 share and this is number 2 share. At the same time, the price of this whole share was, for example, if the par value was $10, it will also be divided into two parts, $5 and $5. So price gets half and the number of shares gets double if it is 2-for-1 stock split. Let's suppose it is 3-for-1 stock split. It means that divide one share into three parts. So now we will be having 3 shares, 1, 2, 3 shares, and the price will be divided into 3 parts. The price will be 3.33 each part. Okay, so stock split is actually happens when the company's management decides to increase the number of shares and decrease the value of the share due to many reasons. So it is issuance of additional shares to the stockholders according to their percentage of ownership. How does stockholders get additional share? In my second example, which is 3-for-1 stock split, a person who was having 1 share, now he will be having 3 shares. Okay. Par value or the stated value also reduces. In my first example, the par value was 10. By announcing 2-for-1 stock split, it was reduced to 5 per share. In my second example, the par value was $10. Now, after announcing 3-for-1 stock split, it is turned into 3.33 for each share. So, the par value or the stated value decreases. Number of outstanding shares increases. Before, in my second example, we had 1 share before the split, and after the split, it comes to 3 shares. Market value of the share also decreases. The main reason behind issuing the stock split is when management believes that the market value of the shares is extraordinarily high, which does not show the true, picture of the company. Then in that case, management can, issue the stock split. And what happened as a result, where in my second example, where 1 share was there in the market, now for 1 share, 3 shares will be there in the market. So supply increases. Okay, and also the price changes, but anyways, when the supply increases, so people they have more options available, and according to the demand and supply rule, if the supply increases, prices goes down. Okay, but there is no journal entry for the stock split. Why there is no journal entry for the stock split? I'll make this point more clear after a while, but do remember, stock split does not affect any part of the stockholders' equity. For example, before the stock split, a company has 5,000 shares and the par value for each share was $10. So the common stock was 50,000. It was before the split. For example, this company announces 2-for-1 stock split. It means that divide each share into two parts. So where we have 5,000 shares, now we will be having 10,000 shares, right? And where the par value was 10 per share, now the par value is going to be 10 divided by 2, 5 per share. So if I want to calculate common stock now, 10,000 shares multiplied by 5, it is still 50,000. So what changes? The change is the value or number of shares increases, but the value of the shares decreases with the same proportion. That's why common stock does not get affected. So when there is no change in the common stock, then there is no need to pass any journal entry. It's just a composition of common stock which is changing. So this is the basic definition of stock split. Here is an example of 4-for-1 stock split. 4-for-1 stock split means divide one share into four parts and divide the value of the share into four parts. So if the par value is 10, it will be divided into four parts. So each share will get a value of 2.5. So before the stock split, let's suppose if ABC company has 4 shareholders and each shareholder was holding 10 shares. So altogether there were 40 shares the company was having. After the stock split, each share is divided into four parts. So now each shareholder, because I have 4 shareholders, so each shareholder is going to have, this is shareholder number 1, this is 2, this is 3, and this is 4. So where one shareholder was having 10 shares, now he is going to have 40 shares. Why? Because 4-for-1 split. So one share will be divided into four parts, 10 shares will be divided into, 40. So first shareholder will have 40 shares, second will have 40 shares, third will have 40 shares, and fourth will also have 40 shares. So basically, where we had 40 shares altogether before the split, now we have 160 shares after the split. Why? Because the 40 shares are divided into 4, so that is 160. This is the effect on the number of shares. For example, the par value for these shares were 10, so the par value is also divided into 4 parts. So each share will get now 2.5. So this happens with the stock split. We have an example over here. Effects of Midland Corporation, assuming that it splits its 50,000 shares of common stock on 2-for-1 basis. It means that each share will be divided into 2 parts and the value will be divided by 2. Okay? Before the stock split, let's suppose this company has, because this is the example in continuation before my previous recording, so I'll be writing the facts and figures for you over here so that you understand. Before the stock split, there were 50,000 shares and the par value was 10 per share. Okay, so our common stock was 500,000. In this example, there was no paid-in capital before the stock split. So total paid-in capital was 500,000. For example, the retained earning is 300,000 before the stock split. So total stockholder equity is 800,000. Before the stock split, the company has outstanding shares of 50,000 and the par value each share was $10. Then company announces 2-for-1 stock split. So let's see the change only. Common stock is not going to change. Why it is not going to change? I'll just describe you at the end of this column. There will be no paid-in capital in excess of par. Total paid-in capital will not change. Retained earnings will not change. There will be no change in the stockholders' equity. Now, listeners, see here. We have 50,000 shares, right? Before the split. 2-for-1 stock split will make them 100,000 shares. Before we have 50,000, now we have 100,000. So how many shares increase? 50,000 shares increase. Par value. Before the split, the par value was 10. We divided the par value into 2. Why? Because it's 2-for-1 split. So each share will get a par value of $5. So what was old par value? Old par value was 10. What is new par value? That is $5. So there's a decrease in the par value of $5. I wrote here -5. Now, if you see new after the split, let's see the effects now. Common stock after the split, number of shares multiplied by new par value. So we get what? 500,000. It was 500,000. It is 500,000 after split. That's why there is no change. Paid-in capital also is not introduced in this case. There is no effect in total paid-in capital and retained earnings, so equity doesn't change. So what actually changes? Only the composition changes. Before we have 50,000 shares, but each share worth $10. But sorry, not worth. The par value was $10. Now we have 100,000 share, but the par value is $5 per share. So only the composition change. No change in the common stock. Okay. Let's move on towards one of the do it exercise. Um, Sync CD Company had 5 years records of earnings. Means for 5 years they are doing very good earnings. Due to this success, market price of its 500,000 shares of $2 par value common stock has tripled from 15 to 45. So what is happening? This company was having 500,000 shares. Due to its success, the market price increased a lot. It becomes $45 per share. During this period, paid-in capital remained the same, 2 million. Retained earning increased from 1,500,000 to 10 million. Now what is happening? President John Albert is considering either a 10% stock dividend or a 2-for-1 stock split. She asks you to show before and after effects of each option on the retained earnings, total stockholder equity, and the par value per share. So these three things we need to show: retained earnings, total stockholders equity, and the par value. We need to show the effects of both options. So let's move on. Uh, we have to draw a sketch like this. Uh, First is original balance. Original balance are given in the data set. Paid in capital, if you see, that's 2 million. Retained earnings are 10 million. So I'm writing them: paid in capital 2 million, retained earning 10 million, total stockholders equity is 12 million. By adding these two, share outstanding are also given 500,000 and the par value is $2 per share. Now we will see what will happen after the dividend on these areas. Okay. After the dividend, the company is going to announce the stock dividend 10% or the split. If company goes for 10% stock dividend, then in that case what will happen? We need to identify is, if you remember, if the percentage of stock dividend is less than 20 to 25%, it's a small stock dividend and we record it at its market value. So let's record it. Stock dividend gets started. Common stock dividend distributable gets credit and completed. Let's say I'm writing it like this, and paid in capital in excess of our common stock. Now let's calculate the stock dividend. Firstly, let's find out how many new shares will be issued. All shares are 500,000. Percentage of dividend is 10%. So 50,000 new shares will be issued. 50,000 shares multiplied by market value because it's a small stock dividend. Market value is 45. 50,000 multiplied by 45, we get 2,250,000 stock dividend. And common stock dividend distributable is going to get credit with the par value. So 50,000 shares multiplied by par value is 2. So I will have here 100,000. And then what's next? Paid-in capital in excess of par common stock. So the difference is going to be in paid-in capital. That is going to be 2,150,000. Okay. Let's check its effect on the transaction. You know that at the issue date, common stock dividend distributable is removed and common stock gets credited. So, because so the final effects are removing this common stock dividend and distributable and converting it into common stock. So, common stock is increasing with 50,000 shares and the par value for them, because common stock is always recorded by par value for them is 2. So basically it is 100,000. Okay. Now let's see its effect on the transaction. After the dividend, what did happen? Before dividend, paid in capital was 2 million. After the dividend, the paid-in capital increases because of what? It increases because of common stock and additional paid-in capital, right? We know that in paid-in capital, we have two heads, capital stock and additional paid-in capital. So both of them, capital stock and additional paid-in capital, they are getting credit. So they're going to increase the opening balance of paid-in capital. So if the opening balance of paid-in capital is 2 million and common stock is 100,000 and additional paid-in capital is 2,150,000. So basically, what we will get? We will get 4,250,000 as a new balance of paid-in capital. 4,250,000. Okay. Retained earnings will decrease because of stock dividend. So how much retained earnings will decrease? Before we have 10 million, right? It decreases because of stock dividend of 2,250,000. Our current balance of retained earning is going to be 7,750,000. But stockholders' equity will not change. It will still be 12 million. Okay, 12 millions means 6 zeros, sorry. 12 million, right? So you can see that on one side, our paid-in capital is increasing. It was 2 million, it becomes 4,250,000. And on the other side, our retained earnings are decreasing with the same amount. It was 10 million, but it becomes 7,750,000. But total equity doesn't change. The shares outstanding, before we have 500,000 shares, we issued 50,000 new shares. So now our shares are going to be 550,000. And par value doesn't changes in case of stock dividend. It was $2, it is $2 after the dividend as well. So these will be the effects on your paid-in capital, retained earnings, total equity, and outstanding number of shares. Let's see what happens if you go for the stock split. So I'm going to just clean this area to do the discussion for stock split. In stock split, we increase the number of shares according to the split instruction, but the par value decreases with the same ratio. So we are going to announce 2-for-1 stock split. So each share will be divided into two parts. So if initially we have 500,000 shares, we will be divided into two parts. So now we will be having 1 million shares. Number of shares will increase from 500,000 to 1 million. What about the par value? Par value will also be divided into two parts. It was $2 divided into two parts. It is split into 2-for-1. So now each share will have a par value of $1. So now what will happen? In capital, we know that there is no journal entry for this split. So in capital was 2 million. It is still 2 million after this split. It was 10 million. It is still 10 million after the split. So total shareholders equity was 12 million. It is still 12 million after the split. What is changing? The change is in outstanding shares. They were 500,000, but now they are 1 million. The par value was $2, but now it is $1. The composition changes, but the contents doesn't change. It remains the same. So this is the difference between the stock dividend and stock split. Let's quickly have a look. Without the stock dividend, these are the unallocated in the column number 1. Okay. So stock dividend increases the paid-in capital and it decreases the retained earnings with the same amount. So as a result, the total stockholders' equity doesn't change. Why? Because one item is increasing, the other item is decreasing in the same ratio. Okay? In the stock dividend, our number of shares increases, but par value doesn't change. In split, paid-in capital, retained earning, equity doesn't change, but our outstanding number of shares increases and the par value decreases. So these are the effects of dividend and split. Let's move towards our third learning objective, which is preparing and analyzing the comprehensive stockholders' equity section. We are done with the paid-in capital discussion in which we talked about the capital stock and additional paid-in capital in chapter number 13. But one item of the owner's equity section, that was retained earnings, we didn't discuss that. Retained earnings are those earnings, we know the basic definition of it, and these are those earnings that are retained in the business, they are not given as dividend. So usually the retained earnings has a normal balance of credit. But if you find the debit balance of retained earnings, it means that the company's performance is in trouble. Company has a deficit. That's why the retained earnings are debit. So retained earning is the net income that a company retains in the business. It is a part of stockholders' equity section because it is a claim of the stockholders on the total assets of the company. Debit balance in the retained earning is identified as a deficit because the normal balance of retained earning is credit. If you see over here, normally in stockholders equity section, just now you did with me, retained earning is added. But if it is deficit, we have to deduct it. Okay, so same we are doing here. Retained earning is a deficit, so it is deducted. Equity decreases because of this deficit. Sometimes we have, why do companies maintain the retained earning? Because of restrictions on them. These restrictions could be legal, they could be contractual, and they could be voluntary. Legal restrictions are employed by the authorities. the law of the industry or the country wants you to maintain that much amount of retail earnings. That's why you cannot just withhold profit as dividend. You have to keep something with you because of the legal restrictions. Contractual restrictions comes when you sign the contract with the creditors. Creditors wants you to maintain the retained earning some particular amount or some particular percentage. They don't want you. Creditors don't want you to distribute all the retained earnings as dividend. They want you to keep some for the security sake. And then the third one is voluntary restriction. Voluntary restriction comes from the company's own understanding. Company wants to maintain a proportion of earnings as retained with them for the future expansion purposes. So there are three categories of restrictions on the retained earnings. Now I'm going to start the preparation of the retained earnings, preparation of the retained earnings statement. So for that purpose, one important thing is retained earnings are increased or they increase because of income, net income. They decreases because of losses. They also decreases because of dividends, right? And they also increase or decrease because of the previous year's adjustments, prior period adjustments. Now, why do we take prior period adjustments? Means prior years, previous year's adjustments into the retained earning account that we create a base for it. For example, you are preparing the retained earnings statement of 2022 year. During preparation of retained earnings statement, you need to know that in 2021 there was one revenue which was not recorded. Revenue was not recorded. Let's suppose the revenue was of 50,000 which was not recorded. When you did not record this revenue of 50,000, the revenue was, you can say, it was understated. It was not recorded. The revenues were less. They were understated. Because the revenues were less, due to this, your net income was also understated. If the revenues increases, your net will come. So your net income was also understated. Okay. In 2022, let me just close my internet because I'll keep on getting the notifications. Okay. Um, in 2022, when you are preparing the retained earnings statement, you have to identify this understated net income. Why? Because we all know that by the end of every year, the net income account is closed. Income summary account is closed in the retained earnings statement, in the retained earnings. Right? Income summary gets debited, retained earnings gets credited. So, if we just simply record the revenue in 2022, we are doing it wrong because income statement belongs to one particular year. In 2022, income statement is only for 2022 items, not for 2021 items. So where we will rectify it? We will rectify this revenue, this understated net income in the retained earnings statement because last year net income is already closed in retained earnings. That's why when in 2022 you are preparing the retained earnings statement, you adjust to the adjustment of prior years. So if last year your net income was less recorded, what you record now in the retained earnings statement, that will be correction of error in the last year and will increase your retained earning. If net income last year was overstated, it was recorded more, then in that case, in current year retained earnings statement, we do the correction by decreasing the retained earnings. These are known as prior period adjustments. So let's quickly have a look at the details of it. Correction of an error in previously issued financial statements are done. They are known as prior period adjustments. Why do we have errors? Because of mathematical mistakes, of course, or maybe an accounting principle was not applied properly, mistakes in application of an accounting principle, or maybe you overlooked or misused a fact, you did not record the fact properly. So While preparing current year retained earnings statement, you will first do the adjustment of these errors. Do remember, if an error has made your net income understated last year, you will add it this year. If an error has overstated your net income last year, you will reduce net income this year in the retained earnings statement. Okay, so let's have this example. This is a simple example when no corrections were required. So how do you prepare this statement of retained earnings? This is Wood Income with Wood Incorporation. Statements of retained earnings for the year ended December 31st, 2017. Put the opening balance. Opening balance you can take from last year's financial statements. So the opening balance is 1,050,000. I already told you income increases your retained earnings. So 2017 net income has increased the retained earnings. We added it. And 2017 dividends have decreased the retained earning. So ending balance becomes 1,110,000. For example, while preparing this statement, you came to know that last year, which was 2016, some items have understated your net income. So because of understatement of net income means net income was recorded less. So in current year, when you will be preparing the retained earnings statement, after putting the opening balance, you will do adjustment for these errors and you will increase. You will put that understated net income over here. Okay. So let's read this scenario, which is telling us an error from the previous year, and let's try to rectify it. Before issuing the reports for the year ended December 31st, 2017, you discover a $50,000 error net of taxes. It was an error of 50,000 that caused 2016 inventory to be overstated. Now, inventory is not the part of income statement, right? But we know that our total inventory, which is available to us, either we sell it, when we sell it, it becomes cost of goods sold, or we keep it with us as ending inventory. This ending inventory goes to the balance sheet. But this cost of goods sold, this is reported as an expense in the income statement. So they say that if inventory was overstated, means ending inventory was recorded more. So what will happen? Your cost of goods sold was actually recorded less, right? Let's take some numbers to explain this. For example, total inventory available to the company was 20,000. You have recorded ending inventory as, let's suppose, 15,000. So there is remaining. Remaining is sold out. That was 5,000. So they say that if this is more, recorded more, the cost of goods sold will be recorded less, right? So some items which were supposed to be recorded in cost of goods sold, they are actually recorded in inventory. So your expenses are understated. When expenses are recorded less, your net income is recorded more, overstated. See here. Overstated inventory cost of goods sold to be lower, understated, and thus net income to be higher in 2016. You need to rectify it. In 2016, net income was recorded more. So what you will do? Now you will reduce the net income to correct it. So let's do this correction. This is the retained earnings statement. So headings are already given. So I have beginning balance, January 1st. How much was that? 1,050,000. 1,050,000. Then adjustment of prior year overstatement because the income was overstated. How much was overstated? 50,000. So what is my adjusted balance? Now 1 million is the adjusted balance. So adjusted opening balance is 1 million. Then add net income of current year and deduct dividends of current year. Net income of current year 360,000, dividend uh, 300,000. So net income is 360,000 and dividends are 300,000. So the ending balance of my retained earnings are going to be 1,060,000. This is how you're going to prepare the statement of retained earnings in the presence of a correction from the prior year CDs. Let's move on towards our next discussion. That is about the conclusion that what are the things which increases the retail earnings and what are the things which decreases the retail earnings. So things which debit or decrease the retail earnings, things which credit or increase the retail earnings. So if the current year has net income, it's going to increase the retail earnings. And if it has net loss, it will decrease the retail earnings. If the prior period adjustment has caused the income to be understated, we will add that net income in the retail earnings, it will increase the retail earnings. But if prior period adjustment has overstated the net income, so we are going to deduct it from the retail earnings. Any type of dividends also decreases the retail earnings. And if you remember chapter number 3, when we discussed the treasury stock, when you sell the treasury stock below its cost and there is no balance in the paid-in capital from treasury stock account, we have retained earnings. So that also decreases the retained earning account. This is a full-fledged example of a Garber Incorporation retained earnings statement. If you see, we have opening balance, then we have correction of understatement for the net income. Something has understated the net income, so now we're going to increase it by adding it. So balance as adjusted becomes 1,100,000, and then net income we're going to add. And after that, in this example, we have both dividends, cash dividend and stock dividend. So in internal column, put them and make the total outside. In my previous example, if you see, we have only one dividend, so I put it in outer column. If you have two, put them in the internal column, make the total, and then put it in outer column. And then you get ending balance of retained earnings. A question, all but one of the following is reported in the retained earnings statement. The exception is. So what are the things which are reported in the retained earnings statement but one is not reported? So that one we have to identify. Cash and stock dividend, yes, they are reported in statement of retained earnings. Net income and net losses are also reported in the statement of retained earnings. When the treasury stock is sold or disposed of below its cost and we do not have balance in premium account, we debit retained earning. Yes, it is mentioned. Sale of treasury stock above cost. No, we do not mention it in the retained earning. Why? Because when you sell the treasury stock above cost, you get a premium account credit, right? So in this case, retained earning is not affected. So D is the answer. So when you prepare the comprehensive stockholder equity section in the balance sheet, after putting the liabilities, you will have equity section. Firstly, paid-in capital will come. Under paid-in capital, you will have capital stock and you will have additional paid-in capital. If you see capital stock, we know that always preferred stock comes first, then common stock, and if still there is a balance in stock dividend distributable account, that will also come. And then you will get the total balance of common capital stock. Then additional paid-in capital, firstly the preferred stock come, then the common stock come. If you have treasury stock premium account, put that. If you don't have, no need to put that. And then make a total of total paid-in capital, that is here. Then retained earning. Now you know how do we get this retained earning. We prepare a statement of retained earning. So they put here, see the note R. When you will go to note number R in the financial statements, you will find out that's a retained earning statement. So that is telling you what is the balance. And then by adding a retained earning into the total paid-in capital, you get total paid-in capital and retained earning. Then you deduct the treasury stock and you get the answer of stockholders' equity section. There are a few things we need to analyze regarding the owner's equity part of the company's financial statement. So let's see this. Um, we will be calculating two ratios in this case. Firstly, we will be calculating the return on the common stockholders' equity. Return means profit on the common stockholders' equity. And the second one ratio which we will be calculating, that will be earning per share. Okay, but in between we have many other things. So let's start it. To illustrate Walt Disney Company's beginning of the year and end of the year common stockholder equity were 31,820. This was beginning, and 30,753 millions. This is ending respectively. Respectively means first comes first. So beginning is first, so this is for beginning. Ending is second, this is for ending. Its net income was 4,687 million and no preferred stocks were outstanding. What we are supposed to do, we are supposed to calculate return on common stockholders' equity. So firstly, we need to see what income is available for the common stockholder. Net income belongs to both preferred and the common stockholders. So you deduct the preferred stockholder dividend out of it so that you only have the income for the common stockholders. And divide it, they said common stockholders equity. So divide it with average common stockholders equity. Average means opening plus ending divided by 2. So when you solve this expression, you will get an answer of 0.15. Multiply it with 100, you get 15%. So remember, this ratio have always an answer of percentage. Okay. What does it tells us? This ratio tells us that for each dollar of equity, the return is 15% on it. Okay. We have a small do-it exercise. Vega Corporation has retained earnings of 5,130,000 on January 1st. So this is the opening balance of retained earning. During the year, Vega earned 2 million of the net income. It declared and paid a 250,000 cash dividend. In 2017, Vega recorded an adjustment of 180,000 due to understatement of 2016 depreciation expense. When the expense is understated, it means that net income will be overstated. So if income was recorded more, this is the time to reduce it. So they want us to prepare the retained earnings statement. So here is the structure. Firstly, the balance on January 1st as reported. So what was the balance, opening balance? That is 5,130,000. I'm going to report it over here, 5,130,000. Then I'm going to write here adjustment for understatement. Sorry, the income was overstated. So overstatement of net income. Or you can also write understatement of expense. So how much was that? That was 180,000. So I'm going to reduce now 180,000. So 5,130,000 minus 180,000, you get 4,950,000. So this is adjusted uh, balance January 1st. Then add the net income. How much is net income this year? That's 2 million, right? So 2 million is net income. So what is going to be the balance? That will be 6,950,000. Then less or deduct dividend. You can write dividend, you can write cash dividend. How much is that? The dividend is 250,000. So let's write here 250,000. So what is the ending balance? 6,700,000. Uh, how does the corporate income statement looks like? So if you see here, we have firstly the sales revenue. If it is a service organization, we will have service revenue. We deduct the cost of goods sold, we get gross profit. This is the first level of profit. Then we deduct all the operating expenses out of it. So we get the second level of profit, which is known as operating profit, or you can say income from operations. Then you add other revenues and gains. Other revenues could be your interest revenue or rent revenue, and gains when you sell the property, plant and equipment or other assets, you can have a gain. So those gains, if you have, you will add them. Then other expenses and losses will be deducted. So you get your third level of profit, which is known as income before income tax. Then you deduct the income tax, and then you get what? You get your last final level of profit, which is known as net income. So in classified income statement of the companies, you will have four levels of profit. You will have gross profit, you will have operating profit or income from operations, you will have profit before tax or income before income tax, and then you will have net income. Okay. The second analysis for the corporations is earning per share regarding the owner's equity section. The previous one, which was return on the common stockholders' equity, that was a percentage ratio, but this ratio is a dollar ratio. So numerator is same, earnings. Earnings are net income, but these belongs to both preferred stock and common stock. So you are going to firstly calculate the earnings which are available for the common stockholders. So this numerator is exactly the same like the previous ratio. But here we need per share, right? So we need the number of shares. So we'll be using weighted average common shares outstanding. In advanced level, we will be teaching you how to calculate the weighted average common stock outstanding. But in financial accounting, it's enough to know that we use weighted average common stock outstanding. This is the number of the shares. When you divide them, you get your answer in dollars. So let's suppose $4 per share. Okay. So we have a question here regarding this. The income statement for Nadine Incorporation shows the income before income tax, that is 700,000. Income tax expense is 210,000. So we know that when we minus income tax expense from income before income tax, we get our net income. So they also gave us the net income of 490,000. If Nadine has 100,000 shares of the common stock outstanding throughout the year, earning per share is, so throughout the year means weighted average shares are 100,000. So this is the net income. There is no information of preferred stock, so we do not have it. So net income divided by outstanding shares, you get your, if you see net income is 490,000 and your outstanding shares are 100,000, so you get an answer of $4.9 per share. So here 4.9 is written, so that's the correct answer. This is it about the discussion of chapter number 14, which was about the stocks, and we also talked about split in this, and we also talked about the retained earnings sections of retained earnings statement, and we also talked about what are the basic analysis ratios regarding the owner's equity of the company. I'll come back with another recording regarding the exercises of chapter number 14 soon. If you want to listen to that recording, please subscribe to the channel. And if you have any questions regarding this recording, please write in the comments section. I'll be answering your comments. Take care, everyone. Have a nice day. Bye.